Paul. Break down the decision for us.
Well, as you said, and as was almost universally expected, the Bank of Canada, Marcia, has held its key lending rate at 5%. The bank, however, does clearly say that it believes its earlier rate hikes are having their desired effect at slowing economic activity and bringing inflation down. The bank says, for instance, higher interest rates are clearly restraining spending. It says the labor market continues to ease. It says that these and other factors, quote, suggest the economy is no longer in excess demand. Excess demand is something that fuels inflation when you have a surplus of dollars chasing a relative shortage of goods and services. And it concludes the slowdown in the economy is reducing inflationary pressures. So all of that is good. All of that seems to be evidence that it was not necessary on this day for the bank to raise its interest rate further. Now, you and I talked earlier about an anticipated subtle change in language in the statement versus the statement in October. We did get that subtle change. Now, it's extremely subtle. The last time the bank made a statement in its final paragraph, this was on October the 25th, it said inflationary risks have increased. And there was speculation that the bank might either eliminate or soften that statement today. And it did soften that statement. This time around, it says the bank is, quote, still concerned about risks to the outlook for inflation. So still concerned, but certainly a softer tone on the possibility of inflationary pressures in the Canadian economy. The bank does say it remains prepared to raise the policy rate further if needed. It said that the last time around, but the setup to that statement is a little softer. And so, the messaging to the bank, I think, is that rate increases are still possible, but they're less likely than they were 3 months ago.
Right. But still leaving that door open just a teeny weeny bit. And I think, Paul, a lot of people are now looking ahead to 2024 and the possibility of a cut.
Right. And there's been some interesting Marcia, interesting moves in the fixed income market immediately at 10 o'clock when the bank made a statement. When I spoke to you earlier this morning, I noted that in a version of the fixed income market, or a corner of that market called the overnight index swaps market, which trades on expectations of interest rates, there was a strong majority call for the Bank of Canada to reduce its benchmark interest rate in early March of next year. As soon as this statement was released, that market adjusted its collective thinking, if you want to call it that, to a 50-50 call. In the overnight index swap market, it's now a coin toss as to whether we get a rate cut in early March or not. That market is now very strongly calling for a rate cut in April, on April the 10th. So the thinking of the market is that rate cuts are coming, but they're not coming as fast as the market thought earlier this morning.
Got it all. Paul, thank you so much for that. Really appreciate the analysis.
Thank you.